Good afternoon everyone, and welcome to the Morrows Monthly update for March. The highly contentious Cypriot bailout package was not enough to stop the rally in global equity markets during the month. We saw continued strength out of the US economy, and that seems to be the locomotive for most other major markets. After strong gains in the first 2 months of the year, the Aussie share market took a breather in March, falling by around 2%. This was despite gains in most other regions. Europe was up 1%, the US was up around 3%, and Japan was up a very strong 5%. China's equity market woes did, however, continue, with their market falling 5%. Bonds were mixed, with safe haven bond yields rising, and the peripheral higher risk yields were flat for the month. Italian bond yields did, however, spike on the back of uncertainty around their election outlook. On the commodities front, oil was up a strong 7% for the month and gold was up around 1%. Most industrial commodities were flat to down, although we have seen iron ore prices continue to slide on the back of oversupply concerns and lower demand from China. Despite the issues we saw out of Cyprus in Europe, the Aussie dollar has remained relatively resilient and rose around 2% for the month against the US dollar. US economic data was again positive for the month as the housing recovery continues to strengthen. Retail sales were stronger than expected, as was employment growth, with the unemployment rate falling to 7.7%. On the negative side, business sentiment did fall, and we also saw manufacturing weaker than expected. In Europe, the issues in Cyprus have added to their woes, and their economic data continues to deteriorate. Their unemployment rate hit an all-time high, industrial production has fallen sharply, and consumer confidence remains very pessimistic. On a positive for Europe, inflation remains quite low. In China, economic data was weaker than expected, with declines in manufacturing activity, industrial production and retail sales. Domestically in Australia, we saw consumer confidence improve and also a better than expected jobs number. Offsetting this, however, was a fall in business sentiment and also building approvals. The RBA left interest rates on hold in their March meeting, and whilst there is an expectation of further rate cuts, we may not see this in the short term. The first quarter of 2013 saw most risk asset classes post very strong returns. We were recently reminded, however, that the debt issues in Europe still remain and are unlikely to be resolved anytime soon. In the current environment, we do not believe that taking on large risk is warranted. Our focus is on risk-adjusted returns, and our portfolios are currently positioned in line with this. In conclusion, we believe that a cautious approach is still warranted in the current environment. Thanks for your time, and we look forward to talking to you again next month.